All right, we'll now start back with problem 4. Here we'll look at a different type of, or different method of taking depreciation. We'll be using units of activity method here. So let's read through it. Younger Bus Lines uses the units of activity method in depreciating its buses. One bus was purchased on January 1, 2024 at a cost of $188,000. Over its 4-year useful life, the bus is expected to be driven 100,000 miles. Salvage value is expected to be $8,000. So here, you guys, where before with straight line we were calculating an annual depreciation expense, the first thing we're going to do here is calculate a depreciation expense rate. Now, it'll be our depreciable cost divided by the activity base. So in this case, that would be 188,000 cost minus an 8,000 residual value. So our depreciable cost is $180,000, which will divide by our activity base, 100,000 miles. And we get $1.80. That's depreciation expense or depreciation cost per mile. And again, that was our, let's add that in. Oh, we didn't need a football update. Oh, no. Went away. Okay. All right, so we got 188,000 divided by 100,000 miles. And that's how we got to our $1.80. I know I said that, but I'd rather you see it there in print. All right, so that's our rate. So what we'll do now with that rate is each year we'll multiply the rate by the number of miles the bus was driven that year. And that's given here in the second part. They say actual mileage in 2024 was 27,000 miles. So in 2024, to get depreciation expense, we'll say $1.80 per mile times those 27,000 miles. So for 2024, comes out to 48,600. Again, we'll multiply the rate times mileage in 2025 and 2026. And we get a depreciation expense for each year. Now, you guys, I mentioned earlier, we can't depreciate an asset below its residual value. So in this last year, instead of just multiplying the rate times the number of miles, what we'll do is add up depreciation already taken. So we'll say 48,600 plus 61,200 plus 43,200. And that gives us accumulated depreciation so far of 153,000. Now we'll subtract that from, and I'm just going to hit this button to turn it into a negative number. So we'll subtract that from our depreciable cost of 180,000. Again, depreciable cost is your cost less residual value. So let's take accumulated depreciation away from our depreciable cost of 180,000. And that's going to give us our depreciation expense in the final year of 27,000. Now see, if you multiplied it out, you would get 32,400. But we can't take that much depreciation because that would bring our book value below our residual value, and we're not allowed to do that. So instead of taking the 32,400, we take the 27,000 that we just calculated, It's just your depreciable cost of $180,000 minus depreciation already taken. Now, if you add these three together and the $27,000, you'll come back to that depreciable cost, of course, of $180,000. And here we're just placing these numbers in this chart, right? So you can see that accumulated depreciation totals to our depreciable cost of $180,000, and book value is left at $8,000 at the end of the final year, and that's equal to our salvage value. All right. I started to ask if you had any questions. That's the point in class where I would do that, but you guys online, please just be in touch. Problem 5. A Kinder Company purchased a new machine on October 1, 2024 at a cost of $145,000. Okay, to begin with here, in calculating depreciation for 2024, you've got to notice right off the bat, we're not working with a full year, right? Only October, November, December, or 3 months of depreciation in 2024. Okay, the cost of the new machine is $145,000. The salvage value is $25,000. And then they also they say the machine is expected to be used for 20,000 working hours in its 5-year life. So they give us the useful life here 2 ways, in working hours and in years. So let's take a look here. First, we want straight line for 24 and 25. Well, the way I always do it in a partial year, I calculate a full year, then I multiply by the number of months we're depreciating and divide by 12. So for 2024, we'll take $145,000, our cost, minus the, see if I can move it where we can see it all. There we go. Minus the salvage value of $25,000. So that gets us to our depreciable cost of $120,000. So for a straight line, we'll divide by the useful life in years. So divided by 5. That gives us a full year's depreciation using straight line. But again, we only want to take 3 months. So we'll multiply by our 3 months, then divide by 12 months in the year. And that gives us our partial year depreciation of $6,000. Now, there's a lot of ways you can do that, and that might have even been the most difficult way, but that way will always work. All right, so our 2024 depreciation expense is $24,000 for a year, but again, it was only partial. See how they did that here? I punched it in the calculator for you, but here it's written out. All right, so we calculate the full year, then multiply it by 3 months and divide by 12 months. That gets us to our 2024 partial year. And then we already know a full year's depreciation is $24,000. Well, it's going to be in service all year in 2025. So that year, our depreciation expense would be equal to the full year, $24,000. Now on B, we're going to do units of activity. So what do we do here? Oh, sorry, my dog's barking. Just give me 1 second. Okay. All right, so we're doing units of activity here. They still want years 24 and 25. So we'll get to our depreciable cost and divide it by the working hours. So that's $145,000 minus $25,000 gets us to $120,000. Divided by 20,000 hours gives us a depreciation expense rate here per hour of $6 per hour. So in 2024, We're going to take that rate and multiply it by the number of hours that the machine was used in 2024. Well, that's given here. Machine usage for 2024 is 3,400 hours. Times our $6 per hour gives us 20,400 for 2024 under units of activity. And then the equipment was used for 12,200 hours in 2025. We'll just multiply that by our $6 rate, and that gives us $73,200 with depreciation in year 2 or 2025. Now notice, excuse me, notice we took a lot more depreciation in 2025 than we did in 2024. Well, why? Well, we're still just dealing with the 3 months, but that caused usage to be way lower in the first year, right? So as usage goes up, so does depreciation expense under a units of activity method. Not the case under a straight line, right? The 6 is lower than the 24, but it's in proportion. Okay, now our declining balance method, the first thing we want to do here is calculate the straight line rate. Then whatever that straight line rate is, we're going to double it. All right, the straight line rate is always 1 over the useful life in years. So here we have a useful life of 5 years, so our straight line rate would be 1 over 5. Straight line rate's equal to 1 over the useful life in years, so we get 1/5. Now, whatever that rate is, we're always going to double it. So that's going to give us 2/5 here. Or 40%. And that's the rate that we'll multiply by not depreciable cost this time, but full cost. That's where double declining balance is a little different. With these two methods, the residual or salvage value is subtracted out in the first year before we start our calculations. Under double declining balance, it's subtracted in the final year, which we're not going to get to here. We're only doing years 24 and 25. So for 2024 depreciation expense, we'll just say 40% of our $145,000 cost. So that's the 145 times the 2/5. But then to account for it only being in service for 3 months in 2024, we have to multiply by 3 over 12 as well. So in punching that in the calculator, it looks like this. I would just say 145,000 times 2, it equals, divided by 5, and it equals. So 58,000 if it were in service for a full year. It's not though, so we're going to multiply by our 3 months, and then again divide by 12 months. And that gets us to our 14.5 for year 1 there. Notice way more depreciation than under straight line. Again, double declining balance is our accelerated method, meaning it'll take more depreciation expense in early years, less in later years. Now in 2025, we're going to take cost minus depreciation already taken, and then multiply by our rate. Now you don't have to worry about the months this time because the equipment was in service for the full year. So we'll just say our 145,000 minus the 14,500 depreciation expense already taken. And then multiply by our rate of 40% or 2/5. So you can say times 2 divided by 5, or you can just say times 0.4, whichever you prefer. And we get our depreciation expense for that year, $52,200. That's probably the most complex of the three, but it's not too bad. Just walk through it step by step. First, you calculate the straight line rate and double it. Then every year until the final year, you'll multiply that rate times cost. You'll multiply that rate times cost minus depreciation already taken. So in the first year, it's just cost. But then in year two, notice we subtracted the previous year's depreciation expense. In year three, we would subtract 24 and 25 depreciation expense before multiplying by the rate. So it just continues in that pattern until the final year, when all you do is subtract prior year's depreciation, and remember, it's the last step there, the salvage value is subtracted in the final year. That was overkill here, though, because we didn't go to the final year. But anyway, let's keep moving. Assuming straight line method, prepare the journal entry to record the 2024 depreciation. Well, that was, $6,000 from up here. A debit to depreciation expense, credit to accumulated depreciation. I think you're probably starting to see a pattern there. Anytime we record depreciation expense, we debit the expense account and credit the contra asset. Now we've got expenses increasing by $6,000, which causes net income and stockholders' equity through retained earnings to both decrease by $6,000. And then the increase in the contra asset account decreases assets. All right, now we're asked to show how the machine would be reported on the December 31, 2024 balance sheet. For you guys, we're going to show it at its cost of $145,000 minus depreciation expense taken in that year, 2024. What we're really subtracting is the accumulated depreciation, which here was $6,000. So we'll show it on the balance sheet at its full cost, $145,000, minus its accumulated depreciation, so far $6,000, leaving us with a book value of the difference, $139,000. I usually use the term book value, but sometimes on the balance sheet you might see it called net PP&E. PP&E standing for property, plant, and equipment. And this is the number, as it says here in parentheses, this is the amount included in total assets. It's also the amount we would use in calculating gains or losses if we sold the equipment, or in this case, a machine. We'll get to those gains and losses. That's a little foreshadowing for you there. We'll get to those gains and losses a little bit later. All right, now we'll look at intangible assets. Well, they have no physical substance. It's not like a tractor, a piece of land, building. Companies acquire intangible assets through two ways. Well, they could purchase them or develop them internally. So they may purchase assets such as patents, trademarks, franchise rights, copyrights, or they could create them internally. Just like tangible assets, intangible assets are recorded at their cost, plus all costs such as legal fees to get the asset ready for its intended use. For instance, you might have to defend a patent in a lawsuit, and if it's successfully defended, those legal fees to defend it would be added back to its cost or capitalized, right, and depreciated over time. Okay, problem 6 here. On 6, we've got Marty Corporation. Just change that to my dog's name. He's sitting here with me now as I record the video. Hopefully he'll be quiet. All right, on problem 6, we have a few transactions here they want us to record. 2, actually. On January 1st, I purchased a small company and recorded goodwill of $200,000. Its useful life is indefinite. Goodwill is the only intangible asset that is not amortized or taken. Amortization is really just we're doing the same thing we would be doing with depreciation. We're taking a part of the cost of the asset as an expense each year that it's useful to the business. But we call it depreciation if we're dealing with property, plant, and equipment. We call it amortization when dealing with intangible assets. But goodwill is the only intangible asset we won't amortize. We just test it for impairment annually and write it down and take the loss if it's deemed to be impaired. Let me go into that a little bit further. The way we end up with goodwill on the books, you guys, is purchasing another business for more than its book value, right? Or more than we can assign to the assets acquired. Anyway, we don't need to get too far into it. Just know that it's not amortized, tested annually for impairment, and written down if deemed impaired. Now, on May 1st, let's get to the one with a little more work here. Purchased for $120,000 a patent with an estimated useful life of 5 years and a legal life of 20 years. Well, you guys, we're going to amortize it over its useful life to the business. Its legal life, as far as amortization goes, is not relevant. So our annual amortization of the patent here would be its cost, $120,000, divided by its useful life of 5 years. It gives us amortization there of $24,000 per year. Now we want to do the December 31 journal entries for the goodwill. No entry required at the end of the year. No adjusting entry required to bring it up to date. Again, it's just tested for impairment and written down if deemed to be impaired. Let's keep moving there. Let's go to our patent. Okay, now we're taking amortization expense of $24,000 in the first year. Now here, you guys, you might be thinking we would credit accumulated amortization. And if you did think that, I understand why. That's what, that's the account we use in depreciation. Is called accumulated depreciation. So you might think accumulated amortization here, but instead of using a contra asset with intangibles, we're going to credit the asset account itself. So we just credit patents, and our intangible assets would be listed on the books at their net value or book value. So what happened here? Expenses increased $24,000, causing net income and stockholders' equity through retained earnings to both decrease by $24,000, and the asset account patents decreased by $24,000. All right, you guys, as always, please be in touch if you have questions. Thanks.